Welcome back. You're watching Stock Watch with me, Zinati Kuma, and joining me to take your stock-related questions tonight are Mark Du Toit from Oyster Investments and Alex Duys from Umthombo Wealth. Be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS on 41392 or on X using the hashtag StockWatch. Thank you so much for your time, gents. Let us get straight to the questions because there are lots of those, but to our viewers, still send your questions. Sibanye Stillwater, because we actually saw the resources complex today up more than 4%, and one of the players that boosted that index was Sibanye Stillwater. And actually, just starting off with you, Alex, before I get to the question, what exactly did investors hold on to here? Because the numbers didn't look so good.
It's a good evening. Yeah, it's a tough one. Because Sibanye is very operationally geared to the commodity prices, right? So whenever you do see a bit of a jump in the commodity prices, there will be quite a high movement. So we refer to as a high beta. And today actually was quite a good day from, gold, palladium, and platinum was actually up. So that's why I think the stock is up, combined with the fact that, even though the results weren't great, some of the fears that a rights issue would be required hasn't really happened. So it seems like they've got enough flexibility for the time being. But if commodity prices remain low for longer, Sibanye is not out of the woods.
Yeah.
Now, why would the investor want to buy Sibanye? Imagine if that investor is highly bullish on a recovery in the PGMs and gold being, call it remaining at 2,500 levels. If that is the case, then perhaps Sibanye can make a bit of a recovery. But the PGM market looks, for me, quite dire at the moment, but you never know when the bottom is.
Yeah.
We could see much more lows going forward, or could actually be at the bottom. And facts that Anglo-American is selling Amplats, perhaps a signal that we are close to the bottom.
Well, the question goes, is Sibanye Stillwater a good share to buy? I don't know. Mark, would you classify it as a good or bad share, or maybe good for a specific timeline?
Yeah, I think that if you're looking for something that's speculative, put a little bit of money in it, maybe it's got a good payoff. But I wouldn't be buying it if it's something that I want to put in my bottom drawer and look at in 10 years' time. There is a lot of risk with Sibanye. They did very well to shore up their balance sheets and buy themselves more time. But they do need commodity prices, PGM prices, to go up. And if the PGM prices go up 10%, it's probably not enough for Sibanye. The commodity price has to go up 20%. Or the rand has to weaken, or something needs to happen to help Sibanye out. They're in a difficult spot at this point in time, and they've done very well to shore up their balance sheet, to make sure that they've got assets ready that they could potentially sell if they need to. But it's a tough time for them.
It was a tough time for Anglo yesterday, Amplats rather, as we saw a decline in their share price. There have been lots of questions on that, and just going to one of them. So there's a question here. Wayne McCurry has given Sasol and Implats as his stock picks even today. The share's fallen further yesterday, but it's up about 5% today. Alex, let's start off with Implats. Would you say that it is offering value, considering also the share price moves we saw yesterday, decline, and then today we saw some buying activity?
Look, it's quite similar to what I said on Sibanye.
Yeah.
So the problem with single commodity players like Impala, which is only focused on PGMs, is that it's really a function of what's happened to PGM price and, of course, the rand dollar price. Now, we don't know if the PGM market is at a bottom or how long it's going to be under pressure. And that's what makes it very, very difficult to time these type of investments. Now, if you can time it, of course, you can make a lot of money. But I remember the previous down cycle in PGMs, investors were calling for the low probably 2-3 years too early. It only really bottomed in 2017, but I remember investors buying in 14 and 15. So these cycles can take longer than you think. Specifically, something like rhodium, which had an incredible period from, call it 2018 onwards. And usually when you have a bit of a bubble and it bursts, it then usually takes time before it actually recovers again, fully grows to the next level. And rhodium was very important in the previous PGM rally, as well as palladium, which traded at quite a sizable premium to platinum. That's only happened really of late since 2017. That premium has almost gone down. So it's very difficult to see why PGM prices really go. And I think the sentiment towards PGM market is quite negative as well. Though I think perhaps too negative, but as it is at the moment, the appetite for platinum from global investors are not looking great.
Yeah. Thank you for catching on to that, Alex, because the viewer did say Implats, but I think they meant Amplats. So thank you for talking about Implats, the one that I actually mentioned. Now let's go on to Amplats. Mark, Implats, particularly, the unbundling that the parent has started embarking on.
Yes, so Anglo American announced that it's going to restructure its portfolio. It wants to unbundle Amplats. One of the problems with unbundling it directly to shareholders is that the current Anglo American shareholders might decide to sell their Amplats on day one, which would put a lot of pressure on the share price. So in order to mitigate that risk, they did a book build. Was it last night or 2 nights ago?
Yes.
And they placed stock in the market. So that's a process whereby institutional investors get an opportunity to buy a large stake in a company, and typically it comes at a bit of a discount to the current trading price. So we saw the next day trading 10% lower, which was actually at the book build price. So now Anglo American owns 5.3% less of Amplats, and ultimately when they place when they distribute those shares to shareholders, then there'll be less potentially shares that need to be sold on market.
And Alex, just on Amplats, because of course you did say that your views are basically the same when it comes to Sibanye and Implats in terms of the PGM market. But do you think for Amplats, maybe the unbundling from Anglo American maybe just provides another layer?
Correct. So there is an enormous overhang of stock or supply now at the moment. And as I alluded to, the demand from global investors is actually quite weak at the moment. So that is why they had to place shares at institutional investors about 10% discount. And we saw the stock the next day also being quite weak. A little bit of a bounce today, but shows you the demand for the shares are not good at the moment. So, and that really asks the question, who's actually going to buy the stake? And it's clear that they can't take all of the shares to the market because then they will be under tremendous pressure. So I guess you should throw the ball back into the park of Anglo American and say, is this really the best way from capital allocation perspective? The timing does seem quite odd for me in the moment, and that unfortunately means that Anglo American platinum shareholders are going to have to face the brunt of this for the foreseeable future.
Yeah, and that's actually the second part of that question, the impact on the Amplats share price. Mark, there are still people buying it. Wayne was even saying that he is still buying it today. But is it a case of if you buy it, you just then have to go with the wave?
Yeah, I think that these shares are going to be very volatile. Typically, commodity shares are volatile at the bottom of the cycle. We saw that the commodity prices being up 1% today and the share prices are up 10%. So that is the kind of ride that you're in for. And you need to decide how much of that you want in your portfolio. Typically you'd have a smaller allocation to very volatile stocks. The problem with volatile stocks is when they go down, you sell them, and when you sell them at the bottom because you can't stand the volatility.
Yeah.
It's almost like it's a problem with human nature, and typically so that's why you have a smaller allocation in your portfolio. So if they go up and down a lot, you don't lose any sleep over it.
Yeah, I need to have a strong stomach and strong nerves. Alex, let's go into retail Pick n Pay. I currently hold Pick n Pay shares. Must I sell now, taking into account the Boxer IPO? Would that be a good idea, Alex?
Look, I don't know what the reasons are for the investor buying Pick n Pay, but I think most of the investors that are buying Pick n Pay at the moment is to want to get their hands on Boxer.
Yeah.
Right, so Boxer is looking very interesting. We've got the information regarding how they're performing financially, the margins they're producing, and their growth rates. So you can make an argument for Pick n Pay if and I say this is a big if, they can get the corporates performing better, let's say even break even to some extent. And, then there's inherently a lot of value in Pick n Pay because the value of Boxer is probably more than the market cap of what Pick n Pay is trading amounts. Pretty much that means a negative value is being applied to the rest of Pick n Pay. So that shows you how lucrative that would be if it comes to the market. I also think whenever the IPO happens, it's going to be very high demand, specifically from shareholders that are not Pick n Pay shareholders. So I would think, this is quite an interesting opportunity to get your hands on this counter. And vice versa, probably going to be weakness on Pick n Pay when Boxer is IPO'd. So yeah, it depends on your appetite, but obviously turnarounds in retail is very difficult. So you can perhaps go read the book from Wiley Besson for some inspiration to think that can be repeated with Pick n Pay. Who knows? But it's certainly not an easy task, and you'll need some luck and I guess some better economic activity to pull it off.
Yeah, it's quite interesting what Alex is saying, Mark, that a lot of investors are going into Pick n Pay to get their hands on Boxer. But at this point, would you not rather wait, considering that when you go into Pick n Pay, you're not just going into Boxer, you're going into the rest of the business that is still quite shaky at the moment?
Yeah, I mean, I think you would need to have a positive view on Pick n Pay. I mean, it's not just the IPO of Boxer is kind of a value unlock story.
Okay.
But at the same time, Pick n Pay is trading where it is because it's had a really difficult time. Shoprite is taking market share, and Shoprite keeps on investing their windfalls in better prices for customers, making it even more difficult for Pick n Pay to compete. So Pick n Pay is in for a tough ride. I do think that they do have options to restructure, and I mean they certainly have a good base, but they probably have to restrict themselves a bit first before they can start to grow again.
All right. More questions coming for you. Sasol. The shares have fallen further. Is it offering value? Mark, Sasol.
Yeah. Well, I mean, the reason why the shares have fallen is because the oil price has come down, and at the same time, the rand also strengthened post the election. So your rand oil price is lower, and that is one of the main drivers of Sasol's earnings in South Africa. So that's the reason why the share price has also come off, which is pricing in a lower rand oil price. I think for me, I've said this before, I think you need a better chemical pricing environment for Sasol. They've got a big chemicals plant, Lake Charles, in the US. It's a fantastic newly built plant, but the problem is since they built it, chemical prices have come back quite a lot, and they're struggling to make decent EBITDA out of the business. And on top of that, they had to borrow a lot of dollars to build it, and so you need chemical prices to go up so that they can start paying down that debt. At the same time, they've got quite a large capex bill in South Africa on their Secunda plant, so that they can meet certain emission standards. And then the other problem that they also have is that they've got the carbon tax in South Africa hanging over their head. There's a lot of uncertainty as to what that final carbon tax bill is going to look like for Sasol. So for me, I think if chemical prices start going up, I think you can buy Sasol. Other than that, I would struggle to see the case to own Sasol.
There are so many ifs there, Mark. And Alex, would the ifs then make it kind of seem like a value trap right now?
Yeah, I probably fall in that bucket, to be honest. So I concur with Mark has said, and I agree with that. Also, the chemical market that's oversupplied usually takes a few years to work through the system. So it's not going to be necessarily a quick recovery. And in the meantime, you've got debt you need to cover, you've got capex. And also shareholders that buy oil companies globally usually gets very good dividends. For example, go look at what you can get for Shell and Total, but at Sasol the dividends are meager, right? So that means foreign investors will probably not look at Sasol. And South African investors can invest offshore also considers other options relative to Sasol. So Sasol is, if you have to rank it from quality perspective, sitting on the bottom tier. Does it mean that Sasol can never make money? Of course not. I mean, if the stars do align, Sasol can do very well. And considering the depressed share price, it could easily double or triple if the stars align. But and I think that's, as you alluded, there's a lot of ifs there, and I think they probably will struggle more. So for me, it's from a balance of probability perspective, we don't really like it. It doesn't mean we will not ever hold it, but at the moment, we're not shareholders.
Well, a sector where we've had an if, but not really Sasol levels, maybe more short term, is on the luxury sector. So there's a question here on Richemont. What do you think about buying Richemont at current prices for a long-term investment, 10 years plus? Of course, we have seen a lot of pressure on that share, not even just Richemont, but on the broader luxury market. Mark, would you say that this is maybe a good buying opportunity at these current prices?
So we've seen all the luxury counters sell off quite heavily. They traded on, they had fantastic earnings growth coming out of COVID. The earnings multiples went up, so the share prices went up even more than the earnings went up. And now I think that the market is starting to reallocate a bit of capital away from the luxury goods into other parts into other sectors, and the share prices have come back. There's certainly nothing wrong with Richemont. I think it's a fantastically well-run business. It's in the luxury space. And I think that the good times will return again. So, we haven't started buying it yet, but I think if you're going to hold it for on a longer term basis for 10 years, then I think you can buy Richemont at these levels.
All right. Alex, would you maybe, Richemont, but also at these levels, because of the pressure that we've seen, would you be going in now, or maybe just waiting a little bit for, a better entry point?
Yes, I concur with Mark, but I'll perhaps just add that remember that luxury goods are quite cyclical, and that's usually tied to economic cycles, right? So over the last 15 or so years, we've had very strong economic environments, specifically share markets, as well as property prices and so forth. So the wealth has become very rich, and as a result, they have spent a lot on luxury. Now, if wealth prices or asset class prices start coming down, or we start having perhaps have recessions, then obviously demand will be under pressure, and there could be some weakness. For example, also in China, at the moment, we are seeing weakness there, and that's having an impact on demand from Asia and Hong Kong and so forth. So that is the cycles that it tends to go in. But Richemont itself is very well positioned. Their balance sheet is strong as a fort. They're generating very good cash flows. They're very prudent when it comes to capital allocation. So certainly from a long-term perspective, yes, I would say it's a buy and hold type of share. But just be cognizant of you could see more ratings derate, or perhaps even a better entry point. So perhaps if you want to buy a small position now and then hold your position over time, because you could be lucky with a better buying price over time.
All right. Talking about buying prices, there is a question on Bell. Could you please ask the panel if the half-year results of Bell, which have reduced the share price now to 40 Rand, affects the proposed payout of 53 Rand in October? Mark, is this one on your radar?
No, it's not really on our radar, but I think the announcement on the vote came out today, so shareholders voted against the arrangement. So, I guess the sort of 50% of the shareholders felt that the price wasn't fair and that Bell's worth more. And so it remains to be seen as to whether a new offer will come at a higher price, or perhaps, Bell has to now trade and improve its numbers, and, the market has to give it the rating that it deserves. But for the moment, I think the offer's off the table.
Yeah, this is very interesting, because I think yesterday it was down to 45 Rand, and today it's down 14% to 40 Rand. Alex, do you think that there's just this nervousness then, if these are what the numbers look like yesterday, and then, the buyout was basically voted against, that people would rather than just leave the stock?
Yes, so Mark is correct. The fact that they voted against it means the offer of 50 Rand is off the table, right? So now the stock valuation is once again a reflection of the fundamentals. So there are some activist shareholders that are involved here, and that were pushing against this vote, and obviously they were successful. And they're arguing that there's much more value in BEL than the 53 Rand. Now, I'm no expert in accounting, so I can't really give you reasons why I would say that is the case. But certainly they think that fundamentals are a lot better for BEL, and there could be a potential takeover target. They even were alleging that if they go delist, someone else will take it out. Something like that. So there's some shenanigans behind the scenes, let's call it that. But for the time being, you know, if you were betting on this 53 Rand, you're going to be disappointed. But doesn't mean another offer could be on the table some stage in the future. But just understand that the sell-off is not due to the performance of the last set of results, which were actually quite okay. It's due to the quality listingness of the table.
All right. Well, gents, before we get to your stock picks, there's a question here on DRD Gold. Of course, the gold counters also participated in the rally of the resources today. Mark, what would you be doing with DRD Gold?
Yeah, so DRD Gold announced recently that they're going to go on a bit of a capex reinvestment program. They've got some new projects that they are going to they're going to start now, extending their tailings facilities, and ultimately it allows them to mine more for longer. I think that given the high gold price environment, I think that they are going to actually earn good returns. But I think that investors get disappointed when commodity prices are high. You expect to earn better cash flow returns from your commodity stocks, and the management team comes out and says we're going to deploy the capital into a new project. So you don't get to see the cash flow return maybe that you're expecting, and so in those cases the market typically puts the mining stock on a lower multiple going forward, because your expected cash flow, you just never get it because they keep doing new projects. But if the gold price stays where it is or it goes up, DRD is going to make a lot of money and going to be able to do their projects and hopefully return some money to shareholders thereafter.
Interesting. Alex, what's your take there?
Yeah, so I think that's 100% correct what Mark said there. So historically, DRD has been the most geared, perhaps almost a harmony, to the South African gold price, or Rand gold price. And they also paid very good dividends. But because of these capex and also some operational issues they've had, they haven't really performed this particular cycle. Also, unfortunately, with gold investors, pretty much DRD, Harmony, Goldfields, and Anglo Gold all busy with some form of capex or deals. So as investors, you see this fantastic free cash flow yields, but you don't really get anything in your pocket or through dividends, or very little. And that is disappointing. Unlike the PGM companies, which actually most of them gave you very good dividends, Barn Northern. So I find it quite puzzling why a lot of investors are buying these stocks if you're not really going to get the cash flows, because the downside could be quite severe if the commodity prices turns against them and yet you didn't receive anything while holding it. So it's a tough one, but I don't know where the gold's going to go. But if, as Mark says, gold will remain strong, then they should be able to generate very good cash flows, which will more than offset the capex.
All right, gents, let's get to your stock picks for today. Mark, what are you hanging your hats on?
Yes, today I'm buying Stadio. I really like the growth that's in that business. They've got 50,000 students at present, grew the number by almost 10%, and they can continue to grow. They have aspirations to grow that number to 100,000 students, the 80-20 split between distance learning and campus learning students. So they've got a lot of growth runway ahead of them as they get more students on their books, plus you get a bit of an inflationary increase, so revenue grows 15-16%, margins improve, and that all drops down to the bottom line. So I think that their earnings can grow around about 20%, even more over the next 5 years, and even on top of that, they still pay a small dividend, so your return is 20-22% a year, and I think that is that's a great return and not well understood by many market participants.
Yeah, all right. What are you picking today, Alex?
I'm going for Sun International. We are a bit more positive about its economic prospects. So I think if the economy does improve, then consumer spending will also improve. And if you look at Sun International, obviously got urban casinos, for example, Grand West in Western Cape, They've got resorts like Sun City, and they've got online betting that's through Sunbet. Now, Sunbet currently is doing very, very well. And then obviously we anticipate some recovery in urban casinos. But they're generating very high cash flows, and they're paying a dividend of more than 9%. And we think they can probably grow earnings, call it high single digits to low double digits. And this is before the Piermont deal. Now, Piermont is something they're looking to conclude first half of next year, pretty much buying Emperor's Palace, the big casino there in the East Rand. And that we think will actually be a very good asset for them and will enable them to deleverage quite quickly. And that will probably bring high dividends and special dividends to the case at some stage in the future. So Santam National, I think, is a geared play with some corporate action and hopefully better returns to shareholders over time.
All right. Well, gents, thank you so much for your time and for your analysis today. That is all for tonight's Stock Watch. Thanks to our guests, Mark Du Toit from Oyster Catcher Investments and Alex Duys from Umthombo Wealth.